With the Wheelhouse, guys. My name is Chris. This is Wheelhouse Trading, and welcome to the Wheelhouse. So I thought today, for me it's Sunday, you'll see this on Monday. I thought today I would do something a little different. We can watch the Bitcoin chart on the minutes. My last video was some technical analysis on Bitcoin and the probabilities of where it's going and to what numbers and dates possibly. Some reasoning and thesis behind that. So we'll just keep this on the chart. But what I want to talk about today is bear markets, some historical statistics, and the bubble triangle. Okay. Every investing mistake is a result of one thing or another. Okay. Either the wrong investment was purchased or the investment was purchased at the wrong time. Okay. In good times, most every investment, including bad ones with bad fundamentals, will actually make you a profit if you know how to understand where you're at in the market cycle. You're in the accumulation phase, which is before the boom phase, and the participation phase, of course, where things do get hot before the distribution phase. And even bad ones in a really strong, uproaring bull market will make you money. Okay, you can pretty much throw a dart at it because, like I always say, green tides lift all boats, and that is very true with the indexes. Okay, yet during market declines, and especially in bear markets, the opposite will hold true. Okay, during bad market times, more than 80% of all the stocks across all the indexes will decline in value, and we're feeling that now, right? Because it's about 80% are under the 200. I read somewhere recently, very recently, which is a big number. I mean, we were around 70%, so we're somewhere between 70 and 80. That's massive, guys. That's a little more than underlying weakness. That's a collapse of the bridge. Like, people are dying. Like, it's bad. I make expressions, but I mean, I'm just saying, like, if you had that much underlying weakness, you build a house on quicksand, your house is going to sink, okay? You need to have a solid foundation. If you have that much underlying weakness in the indexes, they will break. Just like they broke in 1987 when Alan Greenspan did a fast succession of rate hikes, and 1 month later, the entire market broke. Jerome Powell came out with the IMF president and Christine Lagarde not too long ago, maybe within a month, and said this is what's going to happen. Then recently came out and said this is what's going to happen. The market is digesting it, doesn't like it, and it's selling off rapidly. It's breaking. And when you have a slope that's slippery, people can break their neck and break their legs and get hurt real bad. So, what I want to talk about is I want you to understand that when you buy in the distribution phase or in phase 4 where it's declining, thinking you're buying the dip or getting the best price or value, but you're breaking key levels of support, then it is very possible that it can come down further, okay? Therefore, purchasing any investment at the wrong time has a very high probability of loss. And everything in the stock market and the crypto market essentially is about a couple things. Probability, risk, okay? Supply, demand, okay? There's all kinds of subsets around it. Now, prior to every market decline, and particularly leading up to a bear market phase 3 distribution, which I talk about a lot, in this phase there are always unsuspecting or uninformed buyers of stocks and crypto that are being sold investments that will certainly lose money, because the smart money understands the 4 market phases. They understand where to accumulate. They understand what type of cycle they're in. Okay, is it a bull run? Is it a bear run? That's simple. Then there's secular, which are larger. Okay, so it might be a bull run and then a bear run and then a bull run and then a bear run and a bull run, and make higher highs and higher lows along an 18-year period. Okay, so as an example to that, that would be a trend or a cycle that was considered a secular bull would be an example of 1982 to the year 2000. Okay. That's a secular bull, a long-term bull cycle which will have bears in it, but overall the secular macro picture is still bigger bull runs creating longer-term chart higher highs, okay? Now, a secular bear would be a period from like 1964 to 1982, another 18 years. And this is an interesting fact, guys. Upon arrival in 1982, the Dow Jones was up only 1 point over 18 years. Big dip, long sideways, long way back up to the middle, and it was up 1 point. I'm not kidding. When it dropped in, it was 874 points on the Dow Jones, and when it arrived in 1982, back to even, 18 years later, it was 875. It only went up 1 point. That is why understanding where you're at in the cycle is very important. That is why understanding that there's only 24% net gain across the entire stock market for the history of the stock market is important to understand. But Chris, I don't understand. You say 24% net gain. I look at these indexes and they just go up for, a couple hundred years. Yeah, they do. But they also have these long drawdowns, which take time. Okay, here's an example. The indexes, 1 year, make you 20%. Okay? The next year, it makes you 5%. The next year, it makes you negative 10%. So in 3 years, you have 20% minus 10 equals 10. The next year, you have 5. The average between 10 and 5 is 7.5. So an average on all 3 years, you made 7.5%. Now, if you would have just run the one up for 20 and then stayed out for the next 2 years, yes, you would have made 20%. But long-term holders don't do that. Okay, they go through the cycles. And that's why there's only a 24% net gain along the history of the stock market. Most of the times you're sideways or down, 76% of the time, actually. But when it goes up big, okay? And when it goes down hard and fast. Okay, and since the beginning of the stock market, there's been, I believe, a bear market, some form of a bear market every 3.5 years, a recession on average every 5.8 years, and the average decline of the bear market is 29%. Now, there will be long periods of time without a bear market, but this is the average from the history of the stock market. So it's, it's not just taking over the last 20 years or 30 or 40 or 50 years. It's taking over the entire history of the stock market, which gives, tighter averages. Because there's been some bumpy times in the past, 41, after the Vietnam War, we had a hawkish Fed and we had a high inflation. We had the Cuban Missile Crisis, we had that oil embargo and the Nixon scandal in 72. We know about the dot-com, we know about the financial crisis, and now we're in the everything bubble, which could create a lot of downward, then a lot of sideways. It could be a lost decade. I mean, I don't really know that far in. What I do know is it looks like it's about to get hairy and fall off a cliff. And I had showed you what the financial crisis looked like back in the 07, 08 area. We'll just go take a quick look at it really, really quickly just so we can have it up on the screen. Okay, so currently down 24.8% on the NASDAQ. It's pretty significant knowing that the average across the history is 29%. So, on average, we're within 5%, but there's been some ones that have dragged down really far, like the 08 financial crisis and 1929, and there, the one in 72 was big. In fact, in 1972, at the time, it was so bad that on the floor of the stock exchange, they weren't certain if it was going to be a viable entity anymore. That's how bad the market was, and it was nearing and made a close second to the 1929, and that only took a couple things to break it. I have a feeling that we went through this, and then we had this, we came down, there's that, and then I just have a feeling this could be coming all the way down to this 55.97. On average, they're 29, but there have been some savage ones in there, okay? Okay, a few things about bubbles, and then let's talk about the bubble triangle and wrap it up for you. Okay, so where did the word bubble come from? This is a fun fact. Well, it actually came from William Shakespeare in the early 17th century. His famous work, All the World's Stage speech, which was used as an adjective meaning fragile, empty, and worthless like a soap bubble. Okay? It became widely used. Look, bubbles can encourage over-investment, over-employment, oversupply, overbuilding, which becomes inefficient for both businesses and society in general. And bubbles waste resources essentially, okay? I'm just going to read little notes that I took on things. I just think that it's all interesting to talk about and just a little educational here. So Other inefficiencies would be found in the realm of the labor market. Okay. And of course, when the bubble bursts, they become unemployed and layoffs take place, unemployment goes up, and there's less consumer spending, which goes full circle into the earnings reports on these companies. If people aren't paying for products or services, then slowing growth will take place and therefore a lower GDP. Also, these unemployed people eventually start taking jobs in new industries that they were not classically trained for, which creates production gaps or wrinkles in production, but those do work themselves out with proper training and time. The worst part of a bubble, beyond losing all your money, the bankruptcies that happen, the foreclosures that happen, is that when a bubble bursts, it reduces the collateral backing bank loans. Okay? Bubble investors cannot pay back the loans, and this can end up in a banking crisis. This has happened several times and is really bad when it does. Okay? When that happens, you now have a slippery slope on the credit markets, lending, okay, auto loans, home loans, even credit card loans. And then the housing market, okay? No lending or tight lending, high rates, no qualifiers, and a huge industry slowdown in the financial markets overall. Meanwhile, the homeowners are losing value, they can't refi, and if you're an investor with renters, the odds of you having a tenant that starts to default on monthly payments becomes much higher. This is all part of the recipe that goes in that big stew called the financial crisis. Okay? And just so you know, that financial crisis was not specific to the United States, okay? It was a global financial crisis, which included the British banking system, the Irish banking system, and various other banking systems throughout Europe, okay? Of course, as you know, this has had a long-lasting effect or drag on those respecting economies coming out of it. It kind of like boom, rally, try, you're breaking all the supports, kind of bad catalyst, kind of bad sentiment, you know, something positive happens and something negative happens, and it just momentum breeds momentum, and it becomes this nasty, dark situation. Well, meanwhile, because of all this, people lose money, and then they can't pay their homes, so then they lose their home, they foreclose, and then they can't pay debt, so they go bankrupt. So there's bankruptcies and foreclosures. Meanwhile, all the lenders, the banks, they take it on the chin because they're not taking the payments. They have all this default going on. Therefore, they cannot lend anymore to good buyers, and it becomes this massive slowdown in a whole major sector, the financial sector. And that really messes with the economy. And once it comes down, it becomes kind of like a slow grinding halt, and it drags on economies. So coming out of these things, and it takes a while. It's a process. If we fall, I think we're, you know, more at the beginning side of it, not the end. I don't know. I mean, every single one is different. They have characteristics that are similar, and you can look at past historicals to get an understanding. But what I would say is this: I understand all the crashes and all the catalysts going back, you know, at least 125 years, and they all had about 2 or 3 major catalysts that broke the market. We currently have, I think, 8 or 9, which is the most I've ever read about or heard about in my life. I've read a lot of books on this kind of stuff. Yeah, and when I say 8 or 9, I'm talking about hawkish Fed, inflation, food crisis, a war with Ukraine and Russia, supply chains, COVID, pandemic, lockdowns. You add them up, there's a lot more than there has been that broke major markets in the past, capital markets. Believe it or not, there are some positive things that happen with bubbles, as long as it's not as devastating as like the financial crisis or a real estate crash, okay? Number one, the bubble may facilitate innovation and encourage more people to become entrepreneurs, okay? Number two, new developments in technology usually arises during bubbles, and this stimulates future innovations, okay? Number three, bubbles may provide capital technological projects that would not be financed to the same extent in a fully efficient market. So during bubbles, there's glut, there's high demand, and so there's over ordering, and there's over hiring, and there's new innovation, and then the new innovation is sold because there's extra capital that's stimulating the market, so people are trying new things. It's innovative, and that eventually helps GDP in the future for future economic growth. And also, innovation is in nature deflationary as well. So, those are some positive things. Okay, now, what is a bubble triangle? Okay, imagine a triangle. It's got three sides. On one side, you have marketability. One side, you have money and credit. And the other side, you have speculation. Okay, now, marketability is like the oxygen. Okay, it's it brings the people in. It starts the boom phase, which is basically the participation phase. So phase 4 is the phase we're in. Phase 1 is the accumulation phase where smart money comes in. Then there's participation where retail comes in with institutions. That's the boom phase, okay? And in that boom phase, what happens is you get more buyers coming into the market, and the buyers and sellers have enough liquidity out there to exchange and trade every single day. There's plenty of liquidity in the capital markets, okay? And lots of market participants willing to buy and sell, okay? So that creates a big bull run, and that's where the bubble starts blowing up. Okay, it's like right here, okay? It starts to blow up. Okay, so you need that. It's called marketability. And these new buyers, they bid up the price, and it starts new growth, and that bubble starts to grow. Okay, second is money and credit. And a bubble can only form when capital is available and spending is at large. So consumer spending, people have money, cash reserves, they can put it in the market, they can invest, they can bid up prices, things of this nature. And an abundance of credit and capital will drive the bubble larger by taking on more debt and risk, which is usually caused by some form of economic stimulation, either monetary policy or loosening regulation. This could be low interest rates and copious amounts of money printing as an example. Okay, check. Okay, the bubble blew up a little more. Okay, the third part of the triangle that must take place for a large bubble to develop is increased speculation from market participants that were not investors but new to the markets, and usually find specific areas to create asset bubbles, which spills over as a market referred pain, if you will. An example of this would be Ape Mania, GameStop, AMC, things of this nature. And it looks like on the bubble triangle, we have all three checked off. Now, what a lot of people don't know is this little trick called riding the bubble, okay? It's when a pro, somebody that's been in the market a long time, sees a whole bunch of new market participants come in that don't understand the phases or distribution, and they pay overpriced assets. These pros will pay more than they know that they should fundamentally. They'll pay more because they know that these new guys don't know. They're betting on that they don't know things. So they'll pay more because they know that they can sell it to them higher. So that would be, just as an example, let's just say you have, BlackRock or Fidelity or whoever. They'll say, oh, this Ape Mania is going on. Let me load the boat on these shares, because they're going to bid it up. And they're controlling 25%, and it's in the news, and it's getting marketability, right? And so, there's a lot of market participants, so it's going to create an asset bubble, okay, on the security, and let's just buy it higher than we think we should. Let's buy AMC at 12, even though we think it's worth 4 at the time, and, let's let them roll it up to 40. Okay, it's an old trick, Wall Street trick called riding the bubble, all right? So essentially, when you have all three of these, you have marketability, money, credit, and speculation come into play. You have a bubble, and eventually that's when the pros start phase 3, the distribution phase. So they start selling off, sneaky. It shows up in the volume, but the participants don't know about it yet. So that's why I'm so big on studying distribution and these spiking tops and on the technicals, and then looking at the volume, because it lets you know what these big guys are doing. And it's really the only way, if you're not on the inside circle, which I don't think any of us are. So yeah, that's how we kind of spot it. And, we kind of use that information to kind of get out with them. One of the best things you could do in the market is just follow the money. Follow the money. When they sell. When they buy. If you follow the money, fundamentals will come back into play. They will eventually. It's just that right now it's an everything sell off. There's no safe haven. In fact, I looked at the futures and it is disgusting what I just saw in the futures. I'm actually nervous about it. I'm like, oh my God, like it sounds like it's going to be painful. I'm just worried that we're just over in here and this could happen. And it's like, wow, I just, I just saw something at its all-time low and thought it was a good deal, and then I just watched it drop another 20%. And I mean, how much further could it go, right? Well, I mean, essentially they could go all the way down to bankruptcy or get bought out by a bigger company. I mean, and how long can it go? Well, I don't know. This one was 16 months, and we're about 6-7 months in if we're going from about November. I don't know. But yeah, I just thought this was an interesting video just to kind of go through some different bubbles, some positive things about it, some bad things about it, some historical statistics and facts, and this bubble triangle that has been kind of like a confidant or confirmed in every single market top. Yeah, let's leave it there. I appreciate you watching to the end, and welcome to the Wheelhouse.